Welcome back, Turnkey family. This is the Turnkey Brothers podcast brought to you by Boise Turnkey. And on today's episode, we've got Van from SRA 831B Admin with you here today to talk about just some mind-blowing stuff. So the tax code incentivizes people to spend their money. And he has found the 831B specifically that incentivizes people to save. And I'm not even going to give you an introduction because what he has to tell you guys today is going to blow your mind just like it blew mine.
This is episode 17, and you got to stay till the end, where Bree, fly on the wall, absolutely outs Van's dirtiest secret.
Welcome back. Today we have Van and Bree, and Van is doing something very special right now. I am a huge proponent of the tax code. I believe that the tax code was written to incentivize people to make things happen for our economy, to grow our economy, boost our economy. I think it's something that the government saw back in the 50s or even before that, hey, instead of telling people what to do, we can incentivize them on what to do. And that's how roads get built. That's how, like, if you want to grow your population, you give tax credits for people that have more kids, right? It's can be that simple. And for that reason, we're very thankful to have you on the show today to talk about your specific niche in the tax code. So, Van, if you would, just bring us up to speed a little bit for our listeners, where you came from and how you got here.
Yeah, so I grew up in Fruitland, Idaho. So yeah, not too far from here. But yeah, I grew up on a farm, and my dad always owned his own businesses, so I always aspired to try to own my own business. And fortunate enough, got into the insurance business and formed a property and casualty agency in Meridian in the 1990s, when there was only like 23,000 people living in Meridian. And my agency grew, got big, and very, very successful. Life was great. Raised my kids. I was able to coach. Had plenty of free time, and things were fantastic. '08 comes around, and when you start a business, any business, you own all the hats, right? And as things go on, you give the hats away. Well, I was fortunate enough the one hat I wanted to keep was helping business owners manage their risk. And that's what I did. And, these are pillars of the community. These are people that donate to the high schools. I mean, they run a small business. They treat their employees very well and all those things. And then here comes '08 along, where, you saw the Great Recession, and you saw these same people, unfortunately, going out of business because, they just leveraged everything. That's what they knew, right? I mean, they just go buy more stuff. They're CPAs. They grew up with the CPA. They started at $100,000 a year revenue. Now they're running a $5 million business, and they saw the same single CPA practitioner, right? I mean, very limited in scope of what they can do for the clients and all that stuff, right? I mean, we can talk about that another time. Can CPAs really help you out as a business owner? I think that we call them compliance public accountants. They're more compliant about tax code than they are about really tax planning for their business owners. That's probably one of the, and I'm not going to go off this tangent too much, but that's really one of the misleading things that business owners don't even understand is that their CPAs really in a bind whether or not they can really do tax planning for them or not. They just want to make sure the tax return is correct.
Yeah,
Funny enough, we actually had a CPA, a good friend of ours, and he was on the podcast, and he said almost the same thing. That's why he practices more like a CFO of all these companies than really being a CPA for you.
And I think that's one of the things that once you start getting the revenues up, you really got to start looking at. Even I've got a part-time CFO, and he's hugely advantageable. The advantages he brings to us, and amount of knowledge and wealth, I don't justify a full-time one. But man, it's a game changer for us, and so that's a big recommendation I make for a lot of business owners. Anyway, so that's that. But when you look at back at the '08 when the Great Recession, I call it the Great Depression. Let's not go there. That's still to come, huh? Who knows?
Yeah.
But
Canceled.
Anyway, but there's just to be a smarter, better way. And I did see a business owner that had these plans, and man, I thought this is a game changer. This guy's the guy showing up at the auctions to buy his competitors out. This is what smart money does, right? It's not, you're not buying into the stock market when it's all-time high. You're not buying real estate when it's an all-time high, right? But to be able to sit back and tuck away and still have the advantages of it as if you spent it, man, it's huge. And that's really where the code originally originated. I was on 1986 Tax Reform Act. So we're an 831B administrator. A lot of people don't know about the code. It's very similar to the 401k. There's rules and regulations to it. But there's only two tax codes that allow business owners to take deductions and expense it. And one is a 401k.
Everyone knows that.
Yeah, and that's for your retirement and for your employee's retirement, right? And 831B is for a risk that you cannot transfer traditionally through your insurance carriers. So this is risk you're retaining that you can't transfer. So back in 1986, what was happening back then, farmers were crop insurance was going away. So the private sector, insurance carriers were getting out of the crop insurance, said, hey, we went out. And Congress said, hey, you know what? We got to create an incentive here. To your point about the incentives, to own some kind of form of your own insurance company. And then that's where the 831B came up. So keep in mind, too, you guys, that companies like, good example here in town, Micron. Who's selling Micron product liability on their chips? Nobody is. They're self-insuring all that. So these guys all own their own insurance. These big companies have been owning their own insurance companies for decades of years. I mean, right? Microsoft, any airlines, they all own their own insurance companies. They have to. Now they're able to expense all those out, right, out of their operating company, and now they're able to dump it into these insurance companies, and that's a whole other risk profile, Fortune 500 companies that go on in the back room that you as a consumer don't know about, right? I mean, it's big, big business, big money, right? The code, though, was written for the small business owners in 1986. It says, hey, these are farmers.
Yeah.
They're self-insuring crop insurance. We got to create an incentive for them. So if they're profitable, they can take some of that profit and tuck it away and put it into the plan. And that's the incentive. At that point, it was $1.2 million a year you can do. This year's $2.6 million.
Inflation.
Yeah, there's an inflation rider, and the PATH Act made some changes in 2017 to it. They upped it up.
Okay.
So you got to also know, too, both sides of the aisle's a proponent of this tax code. The biggest adopter of this code, though, was Fortune 500 companies, right? Guys that had true tax planners, had a lot of attorneys. They understand the code.
Yeah.
It was Deloitte was their CPA firm, which has 3 times more employees than the IRS does. You know, so these guys adopted it very quickly, right? But again, going back to the small practitioners, they're still trying to figure out if entertainment's still deductible or not, right? From the 2017 Tax Reform Act. So, you know, do they really have time to understand all these codes? And that's part of our job. And that's why we love getting on the platforms such as your guys is just bringing the education level up, right?
No, absolutely.
And really making the business owners aware that there's a better, if you're losing sleep because you're self-insuring, kind of a good example, supply chain risk. There's no insurance policy you can buy for supply chain risk, right? So I'm a distributor. I got to deliver a product to my clients. I got to buy it at X and I got to sell it for Y. And somewhere in the middle there, I got a margin, right? Well, if all of a sudden X has to go up in price, or I can't get X anymore, or if I have to pivot to go to another country to get it,
right,
I can't charge more money back to my in retailer, right? Because he agreed upon my price. So that's a big risk I take, right? So supply chain risk is good. That's just one quick example of I'm self-insuring a lot of my own risk already. I can't transfer it. I can insure my building, I can insure my commercial vehicles, I can insure for work comp, I can do health insurance, I can do all that stuff. Because why? It's a tangible asset, right? It's something that you can smell, taste, and feel. Banks will happy to loan on it. Banks will not loan on intangible assets, which most small businesses value the most. Brand protection, contracts, intellectual property, where you sit in the community, right? Those are things that are business owners, when they go to sell someday, if you can find a buyer for your business, small business, that's what you're selling. You're not selling your vehicles. You're selling the fact that you have revenue and it's kicking off revenue and it's going to be there when I'm gone. That's what you're selling. But all that revenue is tied to intangible assets. And that's where we come in and make sure that business owners understand, hey, you're taking a lot of risk yourself. That you've been incentivized to own this, to do this code. And believe me, guys, we got a lot of roadblocks in the middle of all that, right? I mean, we got to have to deal with CPAs, the knowledge, and this code's been abused. I mean, no shocker, right?
Like everything else.
Exactly. 401ks have been abused. I mean, back in the early 80s, if you were doing a 401k, you guaranteed yourself an audit because the ERISA rules weren't in place yet. Discrimination was still going on. Contribution limits weren't put in place yet. I mean, there was a ton of things going on in there. Why? Because it was new. You know, the challenges we have is this code's been around for almost 40 years. One of the things I should mention, too, is warranties. I think warranty is a big aspect of it because a lot of businesses today feel like they have to do, in order to compete, you got to really stand by what you sell and what you do, right?
Yeah.
So that really is an unfunded liability on a lot of books today. And that's something we look at too, right? So when we sit down with construction defect, for example, on general contractors, in Idaho, it's 10 years on construction defect. You're on the hook for that for 10 years. Subcontractor default. Most of these guys have a 1 year, 2 year warranty when they go build your house, your building, whatever. Well, if that subcontractor goes out of business and now you got to go do the tile work because the tile wasn't done correctly or the flashing on the roof wasn't done correctly, you as a general contractor now got to go hire another subcontractor to fix that because that's the one that's not around. So there's just a ton of those types of things that we go out and identify with business owners. And we work with all types of different industries, right? So, but it is one of those things that's a challenge for us because it's been one of those things that's been hijacked by state tax attorneys. Truthfully, the IRS likes to hold their head, like, hey, we've taken on 4 cases, we won 4 cases, but they were all related to estate tax planning, not risk management. And I should also mention, we are risk managers. We're not attorneys and we're not CPAs. We hire those people.
Got it. Can I pause and go back to like the supply chain issue and then make it a little bit more relatable just to regurgitate this and make sure I have an understanding? So if you have a flipper that maybe it's just mom and pop, they family flippers and whatnot, they do a flip, they're successful, they put their money into the next deal, and they have extra revenue that they have to put somewhere. They can put it aside for like a supply chain issue because I have a lot of friends that were underwater because their holding times got extended almost double what they were planning for with the supply chain issues. So this could sit in an account that's growing for them, that's not tax or it's pre-taxed, and then they could draw off of that if they can't get their supplies in time to rebuild in the time that they were anticipating.
Yes. So part of the administrator, part of our job as administrator, make sure that something like that would be considered a claim is valid. So good example on that is like if the market tanked,
right,
and now they lost money because the market tanked, that's business risk. But if it's because they got delayed because they couldn't get the framing, they couldn't get the materials or whatever, and it was beyond their control, that's absolutely an insurable risk.
And that allows them to draw from their fund?
Yes.
Okay. So let's talk about this fund then, because you gave a lot of great examples and how to use it. Can you talk more about the fund? Let's say I'm a company that is putting away money into this 831B. What does that holding look like?
Yeah. So, not to get too geeked out, there's a terms in the insurance world that says reserves and surplus. So insurance companies live and breathe to collect premiums, pay the ongoing claims, and at the end of the year, they call it underwriting profit. That's surplus, and then they throw it into their treasure troves of billions of dollars, and they go buy the buildings or they loan the money. I mean, they're one of the biggest lenders of money in our country, really, for like big projects. Zion's building was, that money was borrowed by an insurance company. Insurance company loaned that money. So that's what you end up doing, right? So now you have this thing, so you get to operate like insurance companies do, right? So loans, investments, stocks, bonds, mutual funds. Reserves have to stay liquid, meaning that they can't go into an illiquid investments like a REIT or something like that, where you have to sell something on a secondary market. But if you're in stocks, bonds, and mutual funds and all that good stuff, that's not a problem. That's a reserve. That's money at risk for any given year during that period that policies are in force. Now, these are 1-year policies that we issue, right? So once the policies expire, that the underwriting profit becomes realized, that's surplus. Now that gets to be used for other areas. So in our investment agreements we have as an administrator, there's rules of engagement, and we educate the clients. A lot of the financial advisors, we get a lot of referrals from financial advisors. We get a lot of referrals from CPAs. I mean, our biggest referral source, I mean, I kind of talk about them, but they're still our biggest resource is CPAs. They get it. The guys that are actual tax planners, right?
Yeah, it makes them look good. Like when they have a client and they say, hey, we can stash your money away over here too for that rainy day.
Yeah, absolutely.
Makes them look real good.
The biggest thing is, and hey, we're trying to move this conversation in a way where a normal CPA, you go to any CPA you want to go to today, he's going to ask, first thing he's going to do is, aren't you doing 401k? He has no problem referring a 401k to you, but he just doesn't understand the 831B. And part of our job as a company, is again, like we like being on shows like this, is just getting the education level out there, because we believe this needs to become the next big normal business practice. And it's not because it's COVID-19. I mean, do we really want to put $6 trillion out in the economy again?
Right.
We talk about self-reliance. We talk about entrepreneurs. We talk about you're a bootstrapper. The next time this happens, are you going to rely on the government to keep your company going? Or do you want to do something on your own? We all complain about paying taxes. But unfortunately, they got to be paid, because next time maybe we want PPP again, or do you want to do it yourself?
Right.
And that's really where we're trying to drive home right now. And we think we've got a good message on that, you guys. I mean, this is because here's the other problem. What is going to happen the next time?
Yeah,
What's the
exactly. That's what I was going to say. There's no guarantee that the government will be able to bail us out at
Do
that
we want them
point.
to? Look
Yeah.
at
That's a
the
good question.
domino effects
Yeah.
that's going on right now.
Well,
mean,
I know everybody in the room what we think, but even for those who maybe don't have the same mindset and they were bailed out and they don't see the repercussions just yet, having the ability to take that in your own hands and not be reliant on the what ifs, having control over the what ifs, having agency over what your business will be able to do in any kind of adverse effect, I think that's powerful for anybody.
Yeah, I think it's got to be the way. It's got to be the next. It should be at least part of the solution.
Mhm.
You know, it may not be all the solution, right? Especially with startups and people right when they get hit and hey, I just opened up and this happened. But companies that have got some tenure to them, you know, they've made it through the 5-year test.
Yeah.
You know, not to do something like this, I think is, well, I don't want to get so dramatic to say it's irresponsible, but sometimes when I look at the amount of employees you help support, the amount of revenue you bring, the tax base you are paying, you're still paying payroll tax, you're doing all the things. You know, why wouldn't you want to do this? At least look at it. And that's really the challenge we have, right? It's like business owners are so darn busy and they're just so, and it's like, guys, just take a step. I mean, I love the guys that always got their foot on the pedal and down to
Yeah.
the floor, right? But at some point, you got to come back a little bit and say, hey, what, you know, if I can do something different, if I can make it more palatable for me to manage the risk more effectively.
Mhm.
It
Yeah,
just
as
adds to
companies scale, like there are certain milestones that they hit where they have to transform. They have to, they realize they're making a certain amount of money and they have to do something with that if they want to keep growing their business and they want to be an effective member of their community and give back like most entrepreneurs do.
And as they scale, their risk also scales and
Yes.
it transfers to their employees.
Exactly. I mean, now you got responsibilities as an
Right.
as an employer. I mean, you're helping making house payments. You're doing all those things. I mean, the employees, they deserve all of it, right? I mean, they're working for you, but the reality is you got a big responsibility on your shoulders,
Mm-hmm.
and to mitigate that risk, so the survivability of your company on unforeseen risk. I mean, East Palestine.
Yeah.
How many businesses were forced to shut down that had no coverage for business interruption again?
Right.
We have it going on right now with a tire fire that's going on in the Midwest.
Yeah,
Where-
my home state, Indiana.
Yeah, over
Yep.
2,000 people got evacuated from the town.
Yep.
All those little small businesses out there all have to shut down now. They have no revenue coming in. That doesn't mean the rent stops.
Mm-hmm.
That doesn't mean that employees are going to want to get paid. Loans are going to have to be met, you know? So these are things that guys, it's going on every day of our lives. In fact, it's more so than ever now. And then you look at traditional insurances. We have a gentleman down in Southern Florida, huge commercial portfolio, like $175 million commercial portfolio. His company his policies just got renewed. They got renewed at ACV on roofs, which means actual cash value on the roofs of his commercial buildings. So the next time a hurricane hits, that roof's depreciated down to what the actual value of the building was at the time it blew off the roof, not replacement. So like we live in Idaho, where everything we look at is replacement. You know why? Because we don't have catastrophic losses,
Right.
right? So we don't have catastrophic losses, so we don't deal with this. But other parts of the country where things are being ACV'd on a roof, which means if you have a $50 million building, which in Miami area is not that hard to get there, you might have a roof on there that's going to have to cost you. The roof blows off in a hurricane. You might get a third of what it's going to cost you to rebuild that, put that roof back on that building.
That's wild.
So not only are we talking about risk that's not insured, that you can't transfer through normal means, which we've been kind of talking about with COVID and supply chain and all that, traditional insurances are starting to tighten up. And the reason for that is you as a consumer are only going to pay so much, right? At some point, you're like, no mercy, man. I can't afford to do business anymore. And that's what really was happening in 1986. Rates were going up so high. Like I know mechanic shops. I know guys that run mechanic shops today. Their fathers had to shut down their mechanic practices back in the mid 80s because they simply could not afford the insurance anymore.
Mm-hmm.
And they were required to have insurance if they were going to rent that building from that landlord, right? And they couldn't get insurance anymore. And they literally were forced to shut down.
I want to talk about the Miami roof real quick.
Okay.
Just to maybe simplify this a little more, and because I feel like I've got a good understanding. There's a great analogy. So I've got this $50 million building in Miami, and it is insured for actual cash value, like you said. So let's say the roof blows off. Like, I may be getting paid out a third of what it costs, but then me as the company, or the company I should say, has to pay the other 2/3 to get the new roof because it's today's market, it's today's prices.
Costs.
Everything goes up, right? Those are things out of my control. So essentially what this 831B is my own personal insurance company that I have tucked money aside that is growing while I put money in it, right?
Yes.
So instead of keeping it at a bank, it's my business insurance growing, so that when stuff like this happens, that money that has grown can be placed into it.
And the reason why that's powerful is would you rather do it with after-tax money or pre-tax money?
Pre-tax money, right?
All day long.
All day long.
Right.
That's the whole point of starting businesses, right?
It just gives you more ammo. It gives you more rainy day fun. It gives you all of those things. And here's what I say to people all the time. When doing this program just gives you a lot more options. And the more options you have, the better decisions you can make for your business. That's it.
Yeah.
You know, it may make sense for him to say, you know what, I'm not even going to rebuild that building. Just let it tear it down. Maybe I'll get some tax write-offs. I mean, we don't know, right? I mean, but the options that are available, you know, I always compare it to like life insurance, right? If you're the breadwinner of your family, you don't have life insurance, you die unexpectedly, your spouse has very limited options, right? If you have life insurance, you're just going to leave the people that you're still alive with better options to make, right? I mean, that's what I'm trying to make it as simple as I can here, right? But the reality is, though, it's for your business, it's the same concept. I mean, it really is. I mean, you want to call it a health savings account, you want to call it anything. It's the ability to build up a rainy day fund that you didn't know about before. Because let's be honest, our code gives a plenty incentive to spend money.
Right.
Yes.
It doesn't give, this is the only code I'm aware of that gives you incentive to save money.
So I want to hit on
huge.
The pre and post tax, just to break it down simply, of like, let's say you have $100 that you want to save. You could put it in the stock market, and that $100 you were taxed on at that point. So that $100 is now going to be 75 or 56 or, you know.
Call it 50 cents.
Well, 50 cents. Okay. It'll be 50 cents. So that 50 cents is not going to grow as much as the $100 and compound as much. So you can take the same $100, shelter it through the 631B.
831.
And 831. Whoa. I'm dyslexic with my words. You can shelter it through the 831B, which is now the full $100. And that's going to compound way faster and further than the post-taxed money.
Exactly. And you got to be disciplined enough to save it. This is going to force you to save it, right?
Exactly. Yeah.
So the other thing I think about, that's the power of the 401k, right? You know, if you got taxed on it. Now, sometimes you do the Roth 401k, which makes sense financially, but at some point when your income gets high enough, you can't even qualify to do the Roth anymore, right? So now the full dollar is going in there, pre-tax. Now down the road, it's going to be taxed, right? But to your point, you got a lot more juice for a lot more better returns.
Yeah. And actually, I would love to compare this to the 401k. It sounds like it's almost apples to oranges, but I was a stocks guy before this, and I've always been against the 401k because I can take my money and I can learn the market enough to put it in, and I don't have to pay somebody whether or not he loses or makes my money. And then also I can invest my money the way that I want to today and move that around as the market shifts, where you put money in your 401k and it's easy. It's the easy button for sure. But like I said, you have to pay somebody whether or not they make you money or they lose you money. And you're going to get that money out of the market after it's already been deflated because inflation happens.
I think 401k is good for at least there's something's being saved, right?
Yep.
But I'm with you on the 401k. I mean, I think the 401k, you know, it's a hoodwink thing, right? I mean, and you know, I always talk about stocks and bonds. You know, the day you need it, I hope to God it's the best price it's ever been. I mean, there's a lot of things to be said about that stuff, right? I think the big thing that we always talk about is when it comes to regulations. 401k and 831B is very similar when it comes to regulations.
Right.
It's definitely an apple and a star fruit. I mean, it's completely different what we're trying to accomplish. What we say is without the 831B, the 401k is at risk because for business owners are funding 401ks because they're profitable. They wouldn't be funding if they weren't, right?
Yeah.
Well, okay, with the 831B, it ensures it makes that profitability more likely because they plan for the future with pre-tax dollars. Hopefully it's been growing. Hopefully it's, we let the financial advisors manage these reserves under the 831B. We're simply the administrator, right? We try to take ourselves out of the conflicts of interest and all that good stuff. There's rules and regulations to everything. And I think that's where I want to make sure the 401k is very regulated, heavily regulated, right? I mean,
Yeah.
831B is as well. There's rules and regulations to it. And again, that's part of our job. One of the things that when I first started looking at this, 2008, I mean, I got into this because of the Great Recession, right? So, great time to start a business. Took about 5 years and, we've been very successful the last couple of years, obviously, but just because of what's gone on with COVID, but proof of concept, who would have thought?
I just want to say that it seems like all of the benefits that a 401k has, the 831B also has, because you can lend against it. It can be given to a financial advisor that can help that money grow, and it's pre-tax money.
Well, it sounds like it's the same. One's for a person and the other one's for a business.
Yeah. The only difference is it's a C corp. So the shareholder down the road will pay capital gains or qualified dividends. So there's some rules that we have on distributions, for example, that if they start to overfund, relative to claims that's going on and all this stuff, and believe me, guys, there's some, we don't need to get down in those weeds too much, but there's some rules to this thing. It's not just risk-free adventure thing here, but there's some things that we always make sure our clients are aware of. But the point there is they're able to utilize those monies, but when they take them out, they're at a far lower tax rate than ordinary income is.
Yeah, it's not penalized as much.
That's the big difference, right? That's the big capital gains versus. Now that's a ball that gets kicked around all the time. We don't know if it's going to go up to the, they want to ruin the real estate market, just make capital gains the same as the income rates, right? Nobody will sell anything.
Yeah.
But so who knows what that looks like? We hope our clients win on that. We don't know, obviously, because again, it's moving target, but it's definitely one of those things that has an additional advantage to it. No doubt about it.
So I have two questions. So building this 831B, in doing so, like you said, you'll get with a financial advisor, I assume, right? And they'll help you decide where you want to distribute your money, whether it's money market accounts, treasuries, bonds, right? Yeah. Okay, and you can decide, kind of like a self-directed IRA?
Yeah, I mean, we work with a lot of financial advisors, and so we always, to be honest with you, our clients are fairly sophisticated, smart business people, guys that are not necessarily working in their business all the time, but are really thinkers, on their business. They're going to typically have their own financial advisors, and we don't want to disrupt that.
Yep.
So we always work with those clients and their financial advisors. What's surprising to me a lot of times is these same people don't have financial advisors because they either were burnt in the past or they just don't like it or they want to be control, right? They're control freaks. That's why they're successful, right? So, we'll help them along the way best we can, but we expect money to make money. And so money just can't sit around. Although I'm always surprised every year that we see some client that's got piled up a ton of money sitting in some local bank in their area. And you're like, okay, these are
okay. So
people.
This leads me into my second question, and I love that you talked about that because they want to deploy that money, right? It's sitting in their bank account. They feel safer, less risk because it's there if they need to use it. So this leads into my second question is, as these funds build, because you're earning whatever your rate is on that fund, can you loan against that?
Yes.
Like, so for example, like you buy a house, you can take a HELOC out, a home equity line of credit on that asset. Is this 831B an asset that you then can loan against?
Yes, but only to the shareholders, the owners, arm length transactions, right?
Yeah.
So if let's just say it's a husband and wife, they own a successful business, they own an 831B plan with us. And they've been doing our plan for like 4 or 5 years, whatever. And let's say there's a couple $1 million in there. They can absolutely borrow. They can borrow up to a percentage of it. And
what's the loan to value on that?
Typically, it's 65% of the surplus.
Okay.
And we have to have a performing note tied to it. So now this 831B, it's an investment. Banks, deposits are liabilities, loans are assets, right? So the 831B picks us up as an asset, a loan. Well, who better to loan to than the shareholder of the company? Guess who if they default on? They're defaulting on themselves, right? But we have to make sure the notes are there. So we do all that stuff. We got guys that do lines of credit. Right. I mean, in the world we're in right now, a good example. I mean, I own a couple different businesses. I mean, we're looking at commercial financing on commercial vehicles right now at 8%.
Yeah.
Well, if I got money sitting around, I can't get I can get 8% on my money, but I'm taking a hell of a lot of risk to get there right now.
Yeah.
Where I'd rather just say, well, I'll just loan it out of this entity and pay for this vehicle over here. Why do I want to give it to the bank right now at 8%?
So what are the rates typically?
AFR. So there's a safe harbor ruling by the IRS that if you're going to loan money to other entities, which a lot of businesses loan money to other entities all the time, the least performing note you can say it's performing is using AFR rates, which is the applicable federal rate that banks give each other overnight, which is the lowest interest rates you can find published. So the IRS publishes those rates every month. You can do AFR rates, and you'll find it right now, like what's April 1's rates going to look like.
Yeah.
So that's what you would loan that out. So typically it's going to be less than half of prime, typically. So these are and
Take
guys,
my money.
Yeah. So here's what's happening. This big companies. There's a reason why Warren Buffett owns a lot of insurance companies. I mean, I don't know if you guys know this or not, but
Warren Buffett owns a lot of things.
But his driver was insurance.
Mm-hmm.
His driver, his OPM, other people's money, right? The guy's a master at it, right?
Yeah.
I mean, OPM is a great example of other, so there's a lot of the advantages that come with this code is the planning, the thought, the thinking, how am I going to deploy the cash? What's the timing? And nobody can sit there and time the market. Somebody can sit there and time the real estate markets, any of that kind of stuff. But you can certainly have a gut feeling for certain things, right? And just to be able to prepare for that, it gives you so much more advantages in the world. And that's really what big companies do. That's one of the things that drove me nuts back in 08 and 09. I'm like, some of these big companies are making money. They don't care what the economy is doing. Who's getting most effectively hit by this is small to middle market business owners.
Yeah, exactly.
They don't have a fleet of tax attorneys telling them what to do and how to do it. In fact, most of those business owners avoid the taxes, avoid talking to an attorney because they know they're going to get a bill. And the accountant they got is a high school buddy of theirs they grew up with that was great when I was $1 million company. Now I'm at 10. I'm blown away when I'm talking to companies that are doing 40, 50, $60 million a year in revenue. And they got a CPA firm that they started with that he's a one practitioner guy and he's got 2 staff people. Like, in all reality, and I don't blame the guy, but is you really looking out for your when we go around talking? So there's not one CPA that loses sleep because you're paying taxes. They might lose sleep if you're not paying taxes.
Right.
Is that really a partner?
Yeah.
Again, I keep traveling back to this conversation.
Yeah, your
with the
process.
CPA.
Yeah, your process has to, or your processes have to grow with you and scale with you.
And hey, sometimes you just outgrow people.
Yeah, and I want to talk to your tax code point specifically because if you have the one guy who may have 2 staff members, I heard this a while ago, but if you were to sit down and read the tax code yourself, it would take you decades, if not centuries, to read all the tax code yourself. So to stay with the same person who only knows the tax code the way they know the tax code and not like somebody else who specializes like a surgeon on doing brain surgery, you're not going to scale your company and your risk accordingly.
Yeah.
No.
And I have a burning question. So what happens if successful business, you don't have to use this 831B. What happens if you go to sell the business? Does the 831B get sold with it or do you just pay capital gains?
Great question. So we see it played out a couple different ways.
Okay.
The first one is it gets shut down. You close the business. You sell the business. You can wait a couple years and then shut down the 831B, right? And then everything will come out at capital gains. Again, we hope our client won on that.
Yeah.
The other thing that we've seen that's really big is when you go to sell your business and you have rep and warranty. One of the things that we've seen in the last couple of years with the amount of VC money that's been floating out there is transactional risk. So a lot of business owners either have to hold a note themselves on their blue sky because banks aren't going to loan on it, or there's going to be, you promised them something that this is my rep and warranty in the community. It's going to drive revenue and blah, 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 right? So we saw a high spike in lawsuits because of rep and warranty. So we actually specifically came out and formed policies that we've identified on risk when you even sell your business. So if you had an 831B all along and now you go to sell your business and you have to hold a note or you promise them certain things, contracts, hey, this guy's gonna continue doing business with you. He represents 50% of my business that I just sold, and they're either gonna try to devalue you because of that, right? A good real estate agent's gonna say, hey, you got a bunch of warranties out here. We're gonna have to honor all those. You want 5x, we got to go to 4x because of that. And you can sit back and say, no. I'm going to keep my 831B open. If you have claims, I'll put it in trust, whatever you need, portion of the funds. So if you have claims, we'll make good on it. Meanwhile, not only are you going to sell me at that's a premium.
Yeah.
Because now that risk for the new owner is taken care of, right? Again, guys, these are just good business concepts, ideas.
So you can warranty the deal.
Oh yeah,
2 years up to 2 years?
3. We do 3 years. It's statute of limitations.
3 years after you sell your business to somebody.
Yeah, because you're going to hold. Well, the other one is the note. You can actually track it to the note. If you're going to have I'm going to have a 5-year, 6-year, 8-year buyout, and now I'm holding a note on that, we'd absolutely tell you to keep that 831B open, and I'll tell you why. Because you got to bring legal action, or you got to go take your business back, which happens. You're going to have startup cat. You're going to have, and this is the bucket of money that's going to do it for you. Because why? It's been deferred. It's not been taxed yet. You just have more of that money to do that. And again, it's just huge advantages. At certain times, it's the difference between living and dying.
Man, you're definitely preaching to the choir right now, because I have a creative deal where I'll have a 10-year note out for the seller's signature right now, and that's amazing, especially for if I'm going to wrap it or wholesale it, then I can keep this open as long as the term of the note, and that's just extra security for everybody involved.
Exactly.
I'm my mind is blown right now. I'm trying to digest all of this.
These are risks you guys are already taking. It's just well, how do we make it more palatable, right? I mean, how do we take this, because we're really not eliminating the risk, right?
Right.
We're just making it more of the ability for you to fight or make the best decisions, be able to be in a position.
Yeah, weather the storm.
Yeah, exactly.
Because this is the only thing that incentivizes you to save.
Yes.
Because I gave that example, if I'm a business and I make $100,000 a year or $50 million a year, I'm going to spend $50 million, because most of the tax code is incentivized for you to spend it.
Yep.
When people say that, there's a lot of people that get mad. Well, you didn't pay any taxes this year. You're a millionaire entrepreneur or whatever. You didn't pay any taxes. Well, yes,
but
they did it because they're smart, but I didn't make any money either. And this is a platform.
Well, you're absolutely right. And it drives you nuts. But hey, it makes a great headline, right? So
not right.
Yeah, but the reality is you spun so much off in the economy.
Right.
Yeah,
and
how many jobs did you create? How many
Right.
services did you pay for?
Yeah.
Yeah. How many other people's
And
mortgages
you're still paying payroll taxes.
Yeah.
You're still paying you're still paying gas taxes. All this other stuff that goes into it. It's just that income side, right? And to me, it's always been, whoever CPA told me this a long time ago, and you guys understand the rule book. You make the rules. We'll go play the game.
Yeah, exactly.
Don't break the rule. Don't play the game right. But whoever knows the rule book the best will always win.
100%.
That's my argument, or my response to people saying, "Oh, you didn't pay taxes." Well, I pay somebody to read the rule book for me,
Yeah.
So that we can invest in the community.
Yeah, the tax code is written, the playbook is written for us not to pay taxes, because we can do better with our money than what the government can do. And they've proven that time and time again. So don't be offended by me because I go and play by the rules and you just haven't even opened the book.
Yeah, 100%.
And that's why they have to pay taxes, because they haven't opened the book.
You said it. You said it earlier. I think it's they recognized, and I thought about this too in the past. It's our code is designed. The reason why we're so financially stronger than the rest of the world. We can get into conversation about capitalism. Forget all that.
Yeah,
I think it's the tax code, because it has created more incentives. I always compare us to water. The American. I think there would still be plenty of people out there throwing tea in the Boston Harbor today, right? I mean, we just hate paying taxes.
Yeah.
But that has created so much wealth in this country, innovation and everything else, that you can't put. The problem is it's invisible, right? You can't put your finger on it. But I absolutely believe that. And And, when you write a code or you do something differently, you might have planned it. Congress might have got together. They wrote a 1,000-page bill, and somewhere in the middle of all that, they missed something.
Mm-hmm.
For us, it was, what is an insurance company under
Yeah.
the 831B? It says you can own an insurance company, but what is it?
Mm-hmm.
And that's really where the IRS says, hey, we think it's this.
Right.
Taxpayer's going to go, I think it's this.
Mm-hmm.
Now, when there's we go to tax court. Now we've had multiple cases where this code has been abused. And again, something completely alternative. And they were cherry-picked cases. Really bad facts. And we don't need to go into detail. We have case studies on it on our website and all that good stuff to talk about. But, now they're holding a hat onto that. But the reality is, this is a legitimate code. It's been passed by Congress, created an incentive for you to own some kind of form of your own self-insuring risk. And if you're already self-insuring this risk, because here's the risk everybody takes. When it happens, I call it the double whammy. Let's talk about brand protection. Doctor, this has happened.
Yeah.
Patient dies unexpectedly due to an infection. Gets sued under his malpractice. Smaller community makes local news.
Mm-hmm.
People stop coming in the front door.
Right.
Turns out maybe the person didn't do something they were supposed to do. Person dies because of it. The doctor's blamed for it. Reputation risk, right?
Yeah.
So now you've got a contraction of income and expenses are going up because now you got to go fight. Now you have the PR war, right? You're going to have to hire the white hats. You're going to have to, how many reviews get going on your website that weren't even patients of yours, and now they're just all over the world. They're hitting you with the reviews, right?
Yeah.
You got to combat all that. So now you got the double whammy going on, right? Where's that money going to come from? You going to run down to the bank and ask, hey guys, I need a bigger line of credit, and they're just, hey, we heard about you in the news yesterday. I mean, it's that kind of a thing today. It's so quick.
Yeah. Well,
and so fast. It just
bring it to home for us. I mean, Matt, you run a short-term management company. So if we get a bad review because one of the guests was salty or a neighbor at the house that we own did something silly, then that bad review is going to carry with us and it'll affect our ability to pay our mortgage and to pay our cleaning gal and to pay utilities and whatnot.
Yeah.
Well, especially when it's unwarranted.
Yeah, especially when it's unwarranted.
Like the doctor example, like they get an infection and they didn't treat it right, but they're still going to blame the doctor for it.
Yeah. And they make local news because of it.
Yep.
And it takes years to get that back.
Yeah, and to go off of another point that Matt made about the you have to spend all the money that you're making to as an entrepreneur. We kind of get in this entrepreneurial cycle where we keep spending to keep the money coming in, and there's no exit strategy besides getting successful enough where we can sell it off and then just live on a beach somewhere. Where this sounds like a exit strategy to me, where you can get to the point where you're comfortable and have enough liability mitigation that is held in-house where you have complete control over, where you can say, okay, now the business can run itself and I can just focus on my passive income.
Matthew, we've seen it in a couple key employees. Okay, if they can't afford to buy my business, I'll sell it at a discounted value, hold a note, have them run it. But I know I got this nest egg sitting over here I didn't have before. To your point about doubling down all the time. I mean, it's what we know, right? I mean, grow. Well, in order to grow, you got to revenue.
But
right?
you can't stop. You can't get off the merry-go-round because if you stop, it dies.
And somewhat.
Or you start paying taxes.
Yeah, and then it gets
which is worse.
Yeah, and it gets crazy, right? I mean, you just double down at some point, and at some point you're like, hey man, I need to step off of this. One thing is when we talk about like who's our typical client, and I've said this for a long time now. It's like, a married couple in their mid-50s, very successful, blood, sweat, and tears into the business, did so well that Johnny went to college, sent all their kids to college, and someday, like the way things used to be, where somebody was going to eventually take over the family business. And now they come back and they say, you know what, Mom, Dad?
They're TikTok famous.
Yeah, I don't want anything. Yeah, I don't want anything to do with it. I'm out. They're going to go do something else. And now Mom and Dad are sitting there, literally looking up at the ceiling in their bedroom at night going, what are we going to do about our business? Who's going to run this thing? How are we going to get out of here? How are we going to enjoy our lives? And this just gives them that ability to give them another option on the table. Believe me, risk is not a problem. There's a ton of risk they're already taking. They're already doing. They either haven't experienced it yet or did it without really realizing it, right? They just took their operating cash flow and made good with it, right? Times were good, right? So they were able to afford that bump along the road. But that's another great point of our program. I mean, it's this long-term strategy, long-term planning that gives just business owners or risk takers or entrepreneurs just better options.
I love that this is also like a premium option for that couple in their 50s looking to exit, a premium option when they go to sell it for somebody looking to buy the business, and take it over. And let's say they want to hold the note, give it a discount and earn money at the same time. Like,
then that note is secured, but by themselves.
Yeah, exactly.
Yeah.
They don't have so much at risk, because they plan for the future.
Man, I got to say, well, I've learned a lot today. I know we both have. And learning more about tax code, I think, is one of the most important things a lot of people can do, especially as they grow and they mature their business. And you've just opened our eyes to something that I didn't even know about. And I really appreciate that because it's so powerful. So as we exit out of here today, we do have a question, and that's, what's one actionable item that an entrepreneur or somebody listening that they can take today that's going to get them further to their goals tomorrow?
I think you can never stop learning. If you haven't learned something in a while, take pause and go learn about something. Read a book. Do something that's going to empower. It makes you better. And I think, one of the things that we really focus on is this code. I mean, and you just said it. You didn't know about this, right? Even though it's been around for almost 40 years. Educate yourself. All of this stuff is another tool in a toolbox.
Exactly.
But given the right time, it's a great, fantastic tool for the right client. It's a game changer, right? So that's what I would say. It's just like, never stop learning. And I think we can lose that, right?
Mm-hmm.
I mean, you get busy, you just keep, hey, an entrepreneur, I love the E-Myth, right? It's like wash, rinse, and repeat. The hardest thing to do is doing the same thing every day, all the time, the same way. That's what most entrepreneurs do, because in order to be successful, they eventually break the walls down. But that's a hard thing to do. But when you get into that cycle, sometimes you can't take yourself out of it.
Yeah, where do you stop?
Yeah. And I think we stop learning. And man, when you start to recognize, hey, man, I haven't learned something new in a while. And I'm not talking about new words your kids came home with and said, well, what does that mean? But
that was a lit example. Fire.
But something that you can bring to quality of your life, quality of people around you, and hopefully benefit to your business.
Yeah,
that's what I would say.
I have a bonus question, and this one's for Bree. Now, Van, you said that you've worn a lot of different hats in your day. What has been your favorite hat, and how do you relate it to an actual physical hat? Like, what kind of hat is it?
Oh, man.
You asked for
Cowboy
weird.
hat.
Okay.
Grew up in Fruitland, right?
Yeah, exactly. I need it. Yeah, I consider myself a cowboy in a lot of ways.
Yeah, sitting there wearing the Idahoan with your sports jacket, jeans, and boots. That makes sense. Yeah.
Awesome.
I was going to wear my cowboy hat today, but
I was going to out you for being a Californian.
Oh, see,
Fly on the wall comes in at the last minute.
I moved here when I was 9. Thank you, Bree. Appreciate that. I moved here when I was 9. I still don't call myself a native Idahoan, but
that's fair.
Lived here for almost 40 years, right?
A long time.
Yeah, a long time.
Don't date yourself.
But yeah, it's true. Central Valley. So
well, Van, we can't thank you enough for coming on our show today. I know this is going to give a huge value to our listeners here. And if there's any way that they want to reach out to you or learn more, how can they go about doing that?
The best way is we're local. We're in Eagle, Idaho, actually. Happy to meet. We got a lot of clients here in the Valley. We got like I said, over 200 advisors all over the country that represent our products. But also too, I think the website's 831b.com. And we were talking about it earlier. Bree was able to get that web domain for us, and we're very excited. And it's been really good for us. I mean, it's people Google it, and we get people all over the country, really all over the world. But so 831b.com, and Bree's our marketing person. She's done a great job. A lot of educational videos are there. Case studies are there. It's really tied to your industries. If you want to read a case study specifically to your industry, we have those available. And then, just reach out through our website and reach one of our team members. My email's VAN at 831b.com. So if they want to email me directly, happy to. But yeah, I think that's the best start. I mean, again, you got to start from learning, right?
Yeah,
I mean, you start learning, you got
to
educate yourself, and I would use 4 or 5 different resources, right? I mean, again, like we beat up the local CPAs enough, but truthfully, they're busy. I mean, especially right now, right? Tax season. So to roll in on this, you're going to have to take responsibility for yourself. At the end of the day, we all know that. And that's just one of these things that you got to do.
Yeah.
So.
I think I found that CPAs to you is 401ks to me. So we can commonly relate to that.
Awesome. Well, for those listeners out there, if you're looking to take action today, like he said, and want to learn something more, head to 831b.com and check out some of the videos that they have, some of the educational platforms that they have on there, and learn a little bit more. Yeah. So, guys, thanks again for coming.
Hey, thank you.
Yep. And hopefully we'll have you guys back soon.
Sounds great.
All right.
Hey everyone, we're the Turnkey Brothers, and thanks for tuning in with us today.
Guys, make sure to bump up our algorithm with those likes, subscribes, share it with somebody that you think would benefit from this episode.
And don't forget to follow us on your favorite social media platforms at Turnkey Brothers. Till next time.